Welcome back to Investing Talk Podcast. Great to have you with us again. Today, we're looking at a company that's certainly seen its share of headlines recently. We're tackling the question, is Wolfspeed a good time to buy now? It's been a real roller coaster, so our goal today is to unpack that complex story. We'll use their recent financial reports, market analysis, all the latest news, really try to help you understand what's truly important here. And hey, before we jump in, just a quick reminder, if you find this discussion helpful, please subscribe, like, and comment. We love hearing from you. Oh, and if there's a specific company you'd like us to look into next time, definitely leave us a comment below after our chat.
Yeah, it's definitely a timely one. Wolfspeed's journey lately has been incredibly dynamic. Seeing such dramatic changes in such a short time frame really underscores why looking at all the angles is so crucial here.
Absolutely. Dynamic is definitely the word. But maybe let's start with the basics for anyone not familiar. First off, what exactly is Wolfspeed? What do they do?
Sure, so Wolfspeed is a key player, really a leader, in the silicon carbide market. They focus on the actual materials and the power devices. Components that go into things like electric vehicles, renewable energy systems, industrial applications. Think power electronics.
Okay, so critical stuff for EVs and green tech.
Very critical. They've positioned themselves as a leader, claiming a big global share in silicon carbide wafer and device production. Their edge comes from, well, a few things. Deep intellectual property, they're vertically integrated, which helps control the process, and they made some really significant early bets on large-scale manufacturing, like their big Mohawk Valley fab, focusing on 200-millimeter silicon carbide wafers.
So a leader in a really important growing field. Sounds great on paper, but like you said, it's been dynamic. Before all the recent big news, their financial situation wasn't quite so rosy, was it? I remember hearing about some struggles.
Not rosy at all, actually. It was pretty challenging. If we look back at their fiscal year 2025 results that ended June 30th, 2025, the picture was concerning. Their revenue was around $482 million, which sounds okay, but it was only up about 2% from the previous year.
Just 2% growth for a leader in a hot market.
Exactly. And even that small increase was mainly higher product revenue being offset by other factors, like a less profitable mix. But the really startling number was the GAAP operating loss. It came in at a huge $581.6 million.
Wow. Over $500 million in operating losses.
Yeah, which resulted in a negative operating margin of, get this, 295%.
Minus 295%. How does that even happen?
It means for every dollar of revenue, they were losing almost $3 just on operations. It widened significantly compared to prior years, mainly driven by the massive ramp-up costs at that Mohawk Valley fab we mentioned. Plus, continued heavy spending on R&D. These things are expensive.
So building for the future was basically crushing their present financials.
Precisely. Their net loss attributable to Wolfspeed hit $643.7 million for that year. That's way up from $383.4 million the year before. It just reflects those rising costs and the huge investments in capacity expansion. The GAAP net loss per share was $5.14.
And what were they projecting back then? Any light at the end of the tunnel?
Well, management's guidance at that point was for only modest revenue growth in fiscal 26. And crucially, they did not anticipate profitability in the near term.
Okay, so loss is expected to continue. What about their overall financial health? Cash, debt.
That was the other major concern. They had about $463.8 million in cash and equivalents, but total debt stood at a massive $3.06 billion.
$3 billion in debt, against less than $500 million in cash.
Exactly. And that debt had increased significantly because of the capital spending on the new fabs. They also had negative free cash flow, meaning cash from operations wasn't even covering their investments.
So burning cash.
Yeah, burning cash, yeah. Operating cash outflow was over $211 million for the year. They were really reliant on raising new debt or equity or using credit facilities just to keep the lights on. It got so serious that the term going concern was actually discussed in their risk factors section.
Going concern. That's the phrase you never want to hear. It basically signals bankruptcy risk, right?
It signals a very high near-term risk, yeah. If their access to credit or equity capital dried up, they were in deep trouble.
Okay, so that paints a pretty stark picture, teetering on the edge.
Yeah.
But then the story takes this incredibly sharp turn. Here's where it gets really interesting, right? This recent transformation.
Absolutely. It's quite the pivot. The narrative completely flipped, moving from that really challenging past you just described to a very different present. Just a few months ago, late June, the talk was all dominated by their bankruptcy filing. That sent huge waves of uncertainty through the market. Stock got hammered.
Right, I remember that uncertainty. Felt like things were falling apart.
But then things started moving surprisingly fast. In July, they announced a preliminary deal, a debt restructuring agreement with their key lenders. That was the first glimmer of hope.
A first step.
A first step. Then by August, they were deep in negotiations. Bankruptcy talks, restructuring discussions. They even managed to reach settlement agreements with major lenders and some big customers, like Renesas Electronics.
Okay, so progress behind the scenes. And then the really big news dropped just recently.
That's the crucial part. On September 8th, just a couple of weeks ago, Wolfspeed announced it. Their plan of reorganization was officially confirmed by the court.
Confirmed, so the path out was clear.
Exactly. That confirmation clears the way for them to actually emerge from Chapter 11 protection. They expect that to happen as early as September 30th, 2025, so very soon.
And the impact of this plan, it's pretty significant, right?
Yeah.
Especially on the debt.
Hugely significant. The headline number is that upon exiting Chapter 11, Wolfspeed expects to cut its total debt by approximately 70%.
70%, just like that.
Pretty much, wiping out almost 3/4 of that massive debt burden we talked about. That dramatically improves their financial flexibility, obviously, gives them breathing room. And, it's created a huge wave of optimism about their future strategy.
I bet the market reacted strongly to that.
Oh, absolutely. The share price surged almost 58% in after-hours trading right after the news broke. A lot of that seemed driven by a real jump in bullish sentiment, especially among retail investors.
Okay, a 70% debt cut is, well, it's game-changing for the balance sheet. It addresses that huge liquidity risk, that going concern issue. But does that massive cleanup mean it's a completely clear slate now? Or are those underlying operational challenges still there?
That's exactly the question you, as an investor, need to be asking now. The debt reduction is monumental, no doubt. It tackles a critical existential threat. And this is but the underlying operational challenges haven't just vanished.
Right. They still have to actually make and sell the silicon carbide efficiently.
Precisely. Removing the debt anchor is huge, but they still need to navigate the ship, They need to achieve long-term profitability, and that means addressing the core business operations.
And it's not like they have the market to themselves, right?
Yeah.
You mentioned competitors earlier.
Definitely not.
Yeah.
While Wolfspeed has that strong position, the early mover advantage, the IP, it's a tough neighborhood. They're up against established giants like Infineon, ON Semiconductor, ST Microelectronics. These companies have deep pockets, existing relationships.
Big players.
Big players. And then you've got emerging suppliers, particularly from Asia, who are investing heavily and scaling up fast. It's a very capital-intensive industry. Technology can change quickly. And as silicon carbide becomes more mainstream, you're definitely going to see more price competition. That could pressure margins.
So even with less debt, the pressure to perform operationally is still intense.
Very intense. And remember that guidance from before the reorganization. Modest revenue growth projected for this fiscal year, still expecting losses, just hopefully narrowing them as the new capacity comes online. Profitability wasn't expected in the near term then, and while the balance sheet looks way better, achieving consistent operational profit is still the main goal and the main challenge.
Okay, so the financial restructuring was step one, a huge one, but step two is execution. Now, despite the good news and the price jump, what did the technical charts look like before this reorganization news, and what should we be watching now?
Right, context is key here. Before this confirmation news hit, the technical picture for Wolfspeed was, frankly, awful. Strongly bearish. The stock had cratered, down over 90% in the past year, just trading in a very low range.
90% down. Ouch.
Yeah. Both the short-term 50-day and long-term 200-day moving averages were sloping downwards and were way above the stock price. That just reinforces negative momentum. Implied volatility was super high, meaning the market was expecting big swings, signaling lots of uncertainty and pretty weak sentiment. And the RSI, the Relative Strength Index, was deep in oversold territory. Basically, technically, it looked very battered.
So a really beaten down stock.
Yeah.
Which makes that 58% surge even more dramatic, I guess.
Exactly. It shows how quickly sentiment can pivot on major news like a successful reorganization. But you have to remember, it's surging from a very, very low base. So now the absolute focus shifts from will they survive to can they execute?
Execution is key. So what are the specific things investors should be tracking? What are the upcoming catalysts?
Okay, there are quite a few things to watch, both short and long term. Short term, the big one is the official emergence from Chapter 11. That's expected around September 30th. That's the formal end of that process.
Okay, crossing the finish line there.
Right. Then, super important, is their next earnings release. Q3 2025 results expected around October 15th. That will be the first real look at their financials post-restructuring. We'll get updated metrics and, crucially, updated guidance from management. That will set the tone.
What else in the near term?
Also, watch for ETF rebalancing around October 21st. Some funds, especially ESG-focused ones, might reevaluate their positions now that the bankruptcy process is ending. That could affect flows. And critically, any news, any disclosures about progress at the Mohawk Valley and Siler City fabs. Are they improving speed? Are the yields getting better? That operational stuff is vital.
Makes sense. And looking at a bit further, long-term catalysts.
Longer term, it really ties back to the core market drivers. Broader EV adoption is huge for them. Landing any large new deals with auto OEMs would be significant. Successfully executing their plan to scale up 200mm silicon carbide wafer production is absolutely key. That's where the efficiency gains should come from. And tied to that, actually realizing the expected cost declines and yield improvements, that's critical for getting to profitability. And then maybe further out, potential partnerships or even strategic investments from major car companies or industrial players could be transformative.
And I suppose there are always rumors swirling around situations like this.
Oh, always. You hear speculative talk. Could they be an acquisition target for a bigger semiconductor firm or even automaker wanting to secure supply? Maybe. Whispers about new product lines for next-gen EVs, potential management changes now that they're out of Chapter 11, unconfirmed reports about expanding into Asia. It's mostly noise until it's confirmed, but it definitely adds to the narrative and keeps the market interested.
Right. So connecting this all back, even with the debt largely gone, the balance sheet repaired, and these potential catalysts on the horizon, what are the risks that you, our listener, really need to keep front and center?
Yeah, the risks haven't disappeared. They've just shifted, maybe. The big one now is execution risk. If there are delays or if they just underperform in ramping up those Mohawk Valley and Siler City fabs, if the yields aren't good, if the costs don't come down, that would be a major setback. It hurts their financials and their competitive standing.
So can they actually build the things efficiently?
That's number one. Number two is potential dilution. Even with less debt, building these fabs and funding R&D costs a lot of money. They might still need to raise capital down the line, potentially by issuing more shares, which would dilute existing shareholders' ownership.
Okay, execution, dilution. What else?
Then you have the broader market and sector risks. Semiconductors is a cyclical business. It's capital intensive. Demand can shift quickly. Things like changes in interest rates, a slowdown in EV demand, any issues with China, trade tensions, all that macro stuff could significantly impact Wolfspeed's results, regardless of how well they execute internally.
Right, they don't operate in a vacuum.
Not at all. And finally, back to competition. It's only going to get tougher. More players are entering the silicon carbide space. Established players are scaling up. That competition could really put pressure on prices and margins over time.
So a much healthier balance sheet, but still facing significant operational, financial, and market hurdles.
That sums it up pretty well.
Which brings us back to the core question we started with. Is Wolfspeed a good time to buy now? It sounds like a yes, but, or maybe a no, but situation. Very complex.
It is complex. And look, we don't give investment advice here, but we can frame the thinking based on the analysis. One analysis we saw rated Wolfspeed a 2 out of 10 before the reorganization news. Why? Extreme cash burn, big losses, too much debt, terrible technicals, extremely high risk.
A 2 out of 10, pretty low.
Very low. Now, the reorganization fundamentally changes the debt picture and the immediate liquidity risk. That's a huge positive. It removes that existential threat. However, the operational challenges, the competition, the execution risk, those are all still very real. So the takeaway is that even now, this stock carries an extreme risk profile. It's really only appropriate, arguably, for speculative investors, people who can genuinely tolerate the potential for a total loss.
Because the path isn't clear yet?
Exactly. The path to sustained profitability, to really proving they can dominate this market operationally, it's still long. And there are plenty of potential bumps or even roadblocks along the way. This requires very close monitoring.
What a story, though. From the brink of financial collapse, that going concern warning, to slashing debt by 70% and getting court approval, all in just a few months. It's a really powerful reminder of how fast things can change in the market and why digging into the details matters so much.
It really is, and it raises a key question for you listening right now to think about. How do you weigh these things? How much importance do you place on a company fixing its financial foundation, which Wolfspeed has done dramatically, versus the ongoing day-to-day challenge of actually running the business well and beating the competition? They've cleared one massive hurdle, the debt, but that journey towards consistent profit and market leadership, that's still a significant climb ahead. It needs constant reevaluation. You can't just look at the balance sheet fix and assume the rest is easy.
A great point to consider. Financial health versus operational execution. Well, thank you for walking us through that complex journey. Hopefully this discussion helps everyone listening navigate the news around Wolfspeed and make more informed decisions. And once again, please don't forget to subscribe, like the show, and leave us a comment. Let us know your thoughts, or if there's another company you want us to examine next time. Thanks for tuning in to Investing Talk Podcast. We'll catch you on the next one.